It's Thursday, 7th of May, 2026. Welcome back to your news update on Blip Brief. Crisp, but almost everything updated every market trading day. We are jumping straight into a massive geopolitical shockwave that honestly completely rewired the trading session over the last 24 hours.
Yeah, it was a wild session.
Right. Picture this geopolitical pressure cooker. It has been boiling for 10 weeks in the Middle East.
Yeah.
And then suddenly it's like someone just yanks the plug out of the wall.
That's exactly what it felt like.
We are seeing these widespread reports circulating about a potential peace accord between the U.S. and Iran. And the global energy markets didn't just react to this, they repriced violently. We were talking about crude oil plunging over 11% in a single session.
Which is just a staggering drop for one day.
It really is. And that violent drop acted as an instant pressure release valve for Indian asset classes. We watched the Nifty 50 surge over 1.2%, and the BSE Sensex climbed over 1.2% by the previous close. So to kick things off, let's look at the mechanics here. Why does an 11% drop in Brent crude instantly trigger such an aggressive across-the-board rally on Dalal Street?
Well, it really comes down to the direct transmission mechanism between global crude prices and India's foundational macroeconomic stability. You have to think of India's economy as an engine that runs almost entirely on imported fuel.
Right, because we import so much of our oil.
Exactly. So when the price of that fuel drops by over 11% overnight, the market immediately recalculates the nation's import bill. It is a profound shift. A lower import bill means less imported inflation. It shrinks the current account deficit, which, if you think of the country like a household, simply means we are sending significantly less money out the door just to keep the lights on.
Yeah, when those inflation fears cool down, it completely changes the calculus for the central bank.
Precisely. It gives the Reserve Bank serious breathing room on interest rates.
Yeah.
And this is why the bullishness wasn't just restricted to equities. If you look at the money markets, the Indian rupee registered its steepest single-day percentage gain in over a month.
Wait, really? The steepest in over a month?
Yeah. And why? Because the sudden drop in oil prices means oil importers don't need to dump rupees to buy dollars at the same frantic pace. Simultaneously, 10-year government bonds rallied sharply. So what you are witnessing is the market aggressively stripping out that geopolitical risk premium that had been, building up over the last 10 weeks of conflict.
Okay, but the ripple effects didn't stop at bonds and equities either, right?
Yeah.
Precious metals caught a serious bid. Gold jumped nearly 2%, and silver surged over 4%.
Yeah, a massive move for silver.
But I have to challenge the overarching optimism here. Are traders front-running reality? Because pricing in peace right now feels incredibly premature. It's like celebrating a monsoon after seeing a single dark cloud.
That is a fair point.
The situation remains exceptionally fragile, and we have entirely contradictory rhetoric flying across the wires right now. You have the U.S., under Donald Trump, actively threatening to resume bombing campaigns if the Strait of Hormuz isn't reopened immediately.
Right.
Then you have China actively pushing for a comprehensive, unconditional ceasefire. The geopolitical gap between Washington and Beijing right now is practically a canyon.
You are right to point out that gap, and frankly, the market knows it too. Traders aren't pricing in guaranteed world peace, they are pricing in the probability of an off-ramp. That 11% plunge in crude reflects the removal of a absolute worst-case scenario.
I see.
However, the Strait of Hormuz remains one of the world's most critical maritime choke points for energy. The threat of renewed military action puts a very hard floor under how far risk assets can truly run. What we experienced yesterday was a relief rally. Investors were entirely hedged for a prolonged escalating war, so the moment diplomatic channels showed life, the capital sitting on the sidelines rushed back in to catch the upside.
Which brings us to a really interesting paradox. We have this broad macro relief rally driven by falling oil, but when we look at the micro reality, the actual corporate earnings coming out right now is a totally mixed bag.
Oh, absolutely.
We are seeing incredible volume growth colliding head-on with severe input cost anxiety.
Oh.
Let's start with the winners. The auto sector earnings are just blowing past expectations. Bajaj Auto posted a massive 34% jump in quarterly net profit, and Mahindra saw an astonishing 53% profit surge.
The auto sector is honestly offering us a masterclass in strategic positioning right now. These companies are generating these outsized profit surges not just by selling more units, but through a highly calculated shift in their product mix.
Meaning they're selling the more expensive stuff.
Exactly. They are aggressively pushing premium models. When a consumer upgrades from, say, a base model commuter bike or an entry-level SUV to a premium variant, the manufacturing cost only goes up marginally. But the profit margin scales exponentially. Add in robust export volumes to emerging markets, and you have the recipe for a 53% profit surge.
But wait, if we look across the broader auto space, particularly at the legacy players, aggressively pivoting to electric vehicles like Hero MotoCorp, that rosy picture completely fractures, doesn't it? They're dealing with severe margin compression. It sounds like they're running a record-breaking marathon, but they're forced to change into untested, expensive shoes mid-race just to keep up with the EV transition.
That is a great analogy. And it illustrates the brutal reality of an industry in transition. Running a legacy automaker right now is like trying to operate two completely different companies under one roof. The traditional internal combustion engine business is a highly optimized cash cow with established, highly predictable supply chains. The electric vehicle segment, however, is a cash incinerator.
Because they have to build entirely new supply lines from scratch.
Right. They are navigating totally new logistics for critical battery minerals, funding immense research and development, and engaging in cutthroat price wars just to secure early market share against these aggressive disruptors.
So the revenue might look good, but the profit isn't there.
Exactly. Top-line volumes in EVs might look healthy, but the bottom-line profitability is razor thin, if it exists at all. These legacy companies are essentially cannibalizing the high margins of their petrol divisions to fund the low-margin reality of their EV future. They are betting that eventually, scale and cheaper battery chemistry will bail them out.
Wow. Well, speaking of margins, if we step away from hardware and look at the tech and fintech space, the digital consumption narrative is roaring back.
Right.
TB fintech profits skyrocketed by 90%. Meesho saw its operating revenue climb by 47%. Paytm actually swung into a full-year profit. It looks like the era of burning venture capital just for user acquisition is finally over.
It really marks a maturation of the Indian digital economy. We're seeing the true power of operating leverage kick in. In the early days of a digital platform, whether it's an insurance aggregator or e-commerce, customer acquisition costs are astronomical.
Right, you have to buy your users, basically.
Precisely. But once a company reaches critical mass, the cost to serve the next marginal customer drops essentially to zero. That is how a 47% increase in operating revenue translates into a significantly larger explosion in net profit. Or how a company pivots entirely from a full-year loss to a full-year profit. The infrastructure is built. Now it's just about funneling volume through it.
But the reality check comes when we look at the old economy sectors. Infrastructure and FMCG are feeling real pain. Shree Cement saw profits fall by 8%, and Godrej Consumer issued a stark warning about near-term margin pressure. And here's what might confuse a listener. If crude oil just dropped 11% and the macro picture is improving, why are these legacy sectors bleeding right now?
Because the physical economy operates on a delay. It is fundamentally about inventory accounting. Digital companies deal in bytes, but cement and FMCG companies deal in atoms. The products they sold and delivered this past quarter were manufactured using raw materials, specifically crude oil derivatives, petcoke, and freight services that were purchased 3 to 6 months ago.
Oh, right. Right in the middle of the 10-week geopolitical spike.
Exactly. They bought raw materials at peak war premium prices, so they are still digesting those bloated input costs. Even though global crude dropped over 11% today, that cheaper energy will not flow through their physical supply chains and reflect in their profit margins for at least another quarter or two. Until that expensive legacy inventory clears out, their margins are caught in a vice.
That lag effect really highlights the friction in the physical economy. Let's zoom out from the quarterly earnings and look at the broader structural shifts happening in India right now. The macro muscle of the country is flexing in ways we haven't quite seen before. India's overall exports just hit record highs, and interestingly, this was driven heavily by an upward revision in services. The Domestic Services Purchasing Managers Index, the PMI, has accelerated to a 5-month high.
And that services PMI accelerating to a 5-month high is a vital health metric. For those tracking it, the PMI is essentially a survey of purchasing managers. It measures the actual order books and business activity on the ground. Hitting a 5-month high signals profound resilience in domestic demand.
Right.
But the record high in overall exports is the bigger story. It underscores a fundamental evolution in what India sells to the world. We are rapidly moving away from the era of basic back-office IT support and business process outsourcing. The global enterprises driving these export numbers are increasingly relying on Indian talent for core mission-critical operations.
And that transition in human capital is creating a wild dynamic in the job market. Within the tech sector, we are witnessing a violent repricing of skills.
Yeah.
Professionals with specialized AI capabilities are currently commanding salaries up to 60% higher than their peers in traditional tech roles.
Yeah, 60% premium is huge.
It is. Yet at the exact same time, major software players like Freshworks and Pocket FM are trimming their workforces by roughly 10% to 11%. The stated reason for these cuts: AI is reshaping their operations and actively writing a substantial portion of their code base. How do you reconcile a 60% salary premium with an 11% reduction in the workforce?
You reconcile it by understanding that the traditional IT services pyramid is being flattened in real time. For decades, the software model relied on a massive base of entry-level coders handling routine tasks, overseen by a thick layer of middle management. That entire structural model is being dismantled by something called agentic AI.
Let's clarify that, because agentic AI sounds like a bit of a buzzword. We aren't just talking about a chatbot that writes a polite email, right?
No, not at all. Generative AI gives you a paragraph of text. Agentic AI is given a goal, and it autonomously executes the workflow to achieve it. You don't just ask it for a snippet of code, you instruct it to build a feature, test the code for bugs, integrate it into the existing platform, and push it to deployment. Yeah, it has agency. When you deploy systems capable of that, you drastically shrink the need for basic coding roles and the middle managers who previously oversaw them.
Wow.
That explains the 10% to 11% headcount reductions.
So the volume of workers decreases. But why they make these massive premium for the ones who stay?
Because the talent pool capable of actually architecting, refining, and securely integrating these complex agentic systems into enterprise infrastructure is incredibly shallow. That scarcity is driving the 60% premium, and venture capital is following the exact same logic. We are observing a sharp pivot. Smart money is walking away from late-stage, bloated software megadeals. Instead, capital is flooding into early-stage deep tech, specialized AI applications, and precision manufacturing.
So the investment thesis has changed completely.
Exactly. They want to fund the architects building the new AI infrastructure, not the labor-heavy software models of the 2010s.
Which raises a crucial, somewhat uncomfortable question for anyone listening who works in the knowledge economy. If AI is already writing half the code at major SaaS companies today, is this 60% salary premium a permanent structural reality? Or are we just looking at a temporary gold rush before the AI inevitably learns to replace its own architects too?
That is the defining question regarding the half-life of technical skills. Historically, every major technological leap, from the internet to mobile apps to cloud computing, creates a temporary, highly lucrative premium for the early builders because demand wildly outstrips supply.
Right, we've seen this cycle before.
However, AI is uniquely recursive. It actively improves its own ability to write and optimize code. As these tools become more intuitive and highly autonomous, the barrier to entry will drop. It is highly probable that the salary premium will eventually compress. The true permanent structural shift isn't the high salaries, it is the absolute reduction in the total human headcount required to build and maintain enterprise software.
It fundamentally redefines the concept of scale. You no longer need 1,000 engineers to build a billion-dollar company. Now, let's connect this theme of radical efficiency to our final story for the deep dive. We started this update discussing how utterly dependent the global economy is on crude oil, how a single geopolitical headline from the Middle East can send shockwaves through bond yields and corporate margins. We are ending today with a scientific breakthrough that attacks both our energy dependency and the global pollution crisis simultaneously.
And this one is fascinating.
It is. Researchers have successfully developed a method to turn plastic waste directly into clean hydrogen fuel using nothing but sunlight.
The elegance of this innovation is truly remarkable. We are constantly battling two seemingly intractable crises. We have the compounding accumulation of non-degradable polymer plastics choking global ecosystems, and the urgent need for scalable zero-emission fuels. Hydrogen is often considered the holy grail of clean energy because when you burn it, the only byproduct is water.
But the problem has always been how we get the hydrogen right.
Precisely. The traditional method is electrolysis, which splits water into hydrogen and oxygen. But electrolysis requires an immense amount of electricity. If you are generating that electricity by burning coal or natural gas, you defeat the entire environmental purpose of the hydrogen. You are trapped in an energy deficit.
So how does this new sunlight method bypass the trap?
Through a process called photocatalysis, the researchers have developed specialized catalysts that absorb solar energy, essentially harnessing the free, abundant light from the sun to act as molecular scissors. These light-excited electrons break the incredibly stubborn chemical bonds in polymer plastics.
Oh, wow.
Yeah. So in one streamlined process, it breaks down the plastic waste and captures the resulting hydrogen gas. It eliminates the fossil fuel requirement entirely, turning a toxic waste stream into a premium zero-emission fuel.
Sounds like alchemy. But let's ground this in reality, because we cover brilliant lab breakthroughs frequently. What does the timeline to actual commercial viability look like? Scaling a delicate chemical reaction from a pristine laboratory beaker to a massive industrial refinery is usually a process measured in decades.
That is the necessary reality check. The engineering hurdles between a lab proof of concept and industrial deployment are monumental. First, you have to dramatically improve the efficiency of the photocatalysts so they can absorb a much wider spectrum of sunlight. Then you have the containment issue. Hydrogen is the smallest molecule in the universe. It notoriously leaks through the molecular structure of solid steel pipes over time. Building the infrastructure to safely capture, store, and transport it at scale is a staggering logistical challenge.
Not to mention the actual plastic they're using. I imagine the lab uses pure, clean polymers, whereas real-world trash is a contaminated mess.
Exactly. Real-world municipal waste is mixed with food, dirt, and chemical dyes. The photocatalytic process must eventually be robust enough to handle severe contamination without degrading the catalysts. So, while the underlying science is proven and undeniably elegant, we are realistically looking at a 10 to 15-year horizon before this technology can make a measurable dent in commercial energy markets or global waste levels.
So we won't be fueling our logistics fleets with recycled water bottles by next quarter. But it proves that the scientific community is actively dismantling the fundamental constraints of our physical economy.
It perfectly ties today's updates together. Whether you look at legacy automakers wrestling with the brutal margins of electric vehicles, software giants restructuring their entire workforce around agented AI, or scientists trying to power refineries with sunlight and plastic, the overarching narrative is identical. The global economy is in a state of rapid, painful, but absolutely necessary transition. Old efficiencies are dying, and new ones are being forcefully engineered.
It leaves you with a profound question to consider as you wrap up your day. If autonomous AI systems eventually handle the intellectual labor and the coding, and innovations like photocatalysis eventually sever our reliance on fossil fuels to power the physical world, what becomes the primary driver of value for human beings? In a world where routine labor and dirty energy are obsolete, how do you position your own skills for the economy of 2025? Just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.